Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Hormiz Fatakia, and Reema Tendulkar will be joining us in just a bit. And while we are waiting for Reema, Hormiz, let's quickly take a look at what the markets are doing. Yesterday was a range-bound session, of course. We ended largely flat. But today there is some uptick that we are seeing. Nifty is up 61 points right now. It has maintained those opening gains that we saw. And in terms of the broader market movers, that's where we are seeing some pressure that has come by. 140-point downtick in the mid-cap index today. And it has seen some recovery from the lows, but continues to be an underperformer. Mid-caps have been under pressure for quite some time now. Nifty Auto, the top gainer today, 0.7% higher there. IT is also contributing to some of the gains that we are seeing. And, it's a very stock-specific market, again, in terms of results that we've been getting. In the Nifty pack, as I said, Nifty Auto is doing really well. So Tata Motors is the top gainer, 2.5% there. Maruti Suzuki, you have a Bajaj Auto, which is doing well. And apart from that, some of these financial names as well doing well. So we have Bajaj Fin and Jio Financials, two of these names which are in focus as we speak. But again, we are in the midst of earnings season. We got those big banking names, and that continues to be the case. IT is almost over, I think, now.
It'll be over today, at least the larger ones, yes. And we count down to the big Infosys results later this evening. And not just Infosys, the two major mid-cap IT names, Persistent and Coforge, also report results later this evening. It's a huge list of companies that are reporting results today, be it Persistent, Coforge, SRF reporting results today, Bajaj Housing Finance reporting results today, Dr. Reddy's, Tata Consumer. So it's a really long list. And you take a look at some of the earnings reactions as well that have come in today's session. Take a look at Jana Small Finance Bank, 7% lower on that stock now on the downside. Idea Forge too, now down 6%. Now remember, Idea Forge was one of the biggest listings of 2023. It had doubled on its listing day, which had a listing day high of around 1,350. And since then, the stock has now just collapsed to 510. So that is one of those stocks that you need to keep an eye out for. The other one, Blue Jet Healthcare, the earnings accident of yesterday was down in a 10% lower circuit yesterday, is down another 5% in today's session. So that continues to make losses in today's session as well. So 5.5% lower on Blue Jet Healthcare as well. And I was just, since as we on the subject of stocks, say hi to Reema Tendulkar as well, Reema.
Hi. You said on the subject of stocks, say hi to Reema.
I can continue with more.
Okay, so with IT, we had to talk about you.
So let's talk about stocks, but this time from the capital goods sector, because it's time for our special segment, Quarter Se Quarter Tak. We'll get you the earnings expectation. Vamakshi is here to tell us how Q1 FI26 will shape up for the capital good companies. Vamakshi, take it away.
Well, absolutely, Reema. A steady quarter is on the cards for capital good players as healthy order books begin converting into revenues. To start with, all eyes are on order inflows. Momentum was held up well this quarter, supported by sustained traction in power T&D, renewables, and the buildings and factories segment. After a prolonged lull, the railway sector is finally showing signs of recovery since April. Early days, but the trend is turning positive. The standout performer, though, Hitachi Energy, with order inflows expected to surge fourfold. BHEL is likely to post a strong 37% year-on-year increase, while CG Power is set for a solid double-digit gain. On the other hand, we do have Thermax as well as ABB. They may see mid-single-digit growth, and Siemens could be the only name in the red with a slight dip in order inflows, a rare miss in an otherwise upbeat sector showing. Next up, revenues. Capital good companies are set to post an average year-on-year growth of 19%, clear evidence that the order backlog is translating into billing. Hitachi Energy once again tops the list with a 37% surge in revenues, thanks to the execution of the Mumbai HVDC project. BHEL and CG Power also stand out with over 20% growth each. Even Cummins, for that matter, is expected to clock 12% growth despite dealing with a high base from last year's pre-buying cycle. ABB and Siemens, after reporting low single-digit revenue growth in the previous quarter, are likely to post revenue growth ranging between 11 to 12%. Thermax is likely to maintain its 12% growth trajectory too. Margins, though, tell a more divided story. Commodity prices, copper, aluminum, zinc, pig iron have dropped, but margin expansion, not for everyone. Expect margin compression at ABB, Siemens, Cummins and CG Power, largely due to high base effects and moderation of pricing power. But three names buck the trend. Hitachi Energy with sharp margin gain of 750 basis points, BHEL with a 600 basis points improvement thanks to improving operating leverage, and Thermax aided by lower losses from bio-CNG and some of the other projects. Profits mirror this margin divide. Hitachi Energy is expected to steal the show with a 13.5 times jump in profits. BHEL is likely to stage a turnaround, swinging from a 211 crore loss last year to 71 crores in profit this time around. Elsewhere, Thermax is set for a 26% plus jump. CG Power may rise 18% and Cummins should post double-digit growth in profitability as well. ABB India is likely to report over 7% growth. Siemens, however, might lag with the slowest net profit growth among some of its peers. As far as valuations are concerned, there's been a reset, a moderation for most players, reflecting the impact of slowing order inflows and weaker infra spend. Hitachi Energy still trades at a premium of 125 times, but the broader peer group, including ABB, Cummins, CG Power, BHEL, as well as Thermax, are more reasonable as compared to earlier levels. In summary, strong order inflows, healthy revenue conversion, and selective margin improvement set the tone for Q1. With valuations not as overstretched as earlier, this quarter will be about operational delivery and who's best positioned to turn the backlog into bottom line strength.
Okay, all right. Thank you so much, Mamakshi, for joining us and telling us what to expect from the capital goods space this time around. To take this discussion forward, we are now joined by Pulkit Patni, who is India Industrial Analyst at Goldman Sachs. Pulkit, good morning. Thank you so much for joining in. You know, we heard Vamakshi right now talking about what is being expected from the sector. And there's a divergence in order inflows as well that we have seen. Order inflow is expected to be tepid for ABB India, Siemens, Thermax, while it is expected to be robust for other companies, the likes of BHEL, Hitachi as well will do well. What does that indicate about the underlying capex cycle going forward?
Sure. Thank you for having me. So we had published a report in April where we had highlighted that in light of the whole tariff-related uncertainty, we expect that private sector capex momentum in India will slow down in Q1 FY25 and things to recover after clarity emerges. Now, what we've seen and what we've flagged in a recent publication is that this seems to have played out. Power sector, which spans across renewables, transmission, distribution, is where award activity has been robust in Q1. Conventional power has been relatively soft because FY25 was very strong. And government-driven infrastructure ordering has been modest in Q1 as well. New manufacturing-related capex is expected to be soft as well. But as I highlighted, power and related infrastructure is going to be strong, and we expect that momentum to continue.
Pulkit, hi, Rima here. What about the outlook on exports? Considering the geopolitical uncertainty that's reigning currently, we're still navigating a deal with the US. Which companies would be impacted and what could be the extent of the impact? And would that be a bit of a problem?
Sure. In Q1, we've actually seen exports get a push as companies wanted to front load their export orders ahead of implementation of any tariff. And hence, we expect industrial companies to report pretty strong export growth in Q1. Part of it could just be front loading from the second quarter. Based on the companies that have reported so far, if you look at the cable companies, both of which have reported, they've actually reported very strong numbers on export. And that is a reflection of what we've seen in terms of front loading of the capex, of the export capex in the quarter.
Pulkit, good morning. Thank you for joining in. You know, a lot of these capital goods companies have run up significantly over the last 8 to 12 months, and be it across sectors, be it the likes of Siemens or be it the likes of the railway names. Does the valuation surge mean that the margin for error this time around is almost zero, if you could call it that, and very little disappointment on either front could maybe trigger a valuation derating in any of these stocks?
Valuation did correct in the earlier part of the quarter, and obviously recently stocks have run up with valuations again looking towards the expensive side. However, our view is that companies where end market outlooks are strong, as I highlighted, sectors like power, its ancillary, transmission, distribution, we think even if Q1 order inflow is relatively weak, market should use that as an opportunity to actually buy into some of these names, given the fact that power cycles don't tend to be small, in which case the order inflow outlook will pick up going forward. Obviously, this would vary stock by stock, but broadly, we think wherever the fundamentals in terms of the demand cycle is strong, they should be good stocks even at these levels.
So, Pulkit, when we talk about order inflows, they will get better. Is it coming in from any new segment? A lot of new segments are also being introduced by these capital good names. There have been a lot of regulations, be it the emission norms, be it new gensets that these guys have been talking about. How do you look at the entire new diversification strategy taken by these companies, and all of this, would that be margin accretive as well?
Sure. So if you look at the past few years, a large part of the order inflow is actually coming from government infrastructure. While government ordering continues to be decent, we've obviously seen moderation on those high levels. Now, when we talk about specifics of where private sector orders have been coming up, as I highlighted, it is renewable power, it is transmission distribution, data centers, and in many cases, even new energy businesses. We've also seen some strong ordering from the electronic manufacturing sector, but the capex intensity of those sectors tend to be relatively light. And from an old economy perspective, ordering in sectors like cement, etc., continue to be fairly strong. So I think it's pretty broad-based in terms of where orders have come through for these companies.
So, Pulkit, which would be your top bets from all the companies that you track at Goldman Sachs? Which are the buy calls? And also give us a picture of the earnings growth expected for the next 2 years and juxtapose that with the valuations.
Sure. So while we don't talk about stocks, we've spoken about the cables and wire sector where we expect strength in terms of the demand outlook both from the domestic and the international markets. And while valuations are broadly expensive, as I highlighted, as long as companies can deliver on their earnings, which in most of these cases is between mid to high teens, we think market should be okay with these rich valuations.
And since we are on that subject of the cables and wire space, Pulkit, competition is one such factor which has been a major trigger in the derating of a sector like paints. You've seen the competitive intensity rising there. A similar trend is emerging, at least in terms of competitive intensity rising in the cables and wire space. But do you see that as a paints moment for this sector, or do you believe that this entire space is big enough to accommodate more players and that the incumbents still have a long runway before the newer entrants eventually start playing catch up?
And this is something we'd also flagged in February this year, that there's a lot of capacity coming in the cables and wire sector. However, a lot of the final outcome on margins will hinge upon how the export market picks up. Let me just remind you, we're talking about a $24 billion export that happens from China and $1 billion of export of cables that happens from India. If we see any shift in that direction, which companies are talking about, then the capacities that are getting added in India could get absorbed. However, if the numbers do not pan out as such, there could be margin compression going forward, because in commodities, typically, when capacities get added, there is margin compression. So this is something we have spoken of in December last year, as well as in February this year. So far, companies that have reported earnings have actually shown robust margins, which means we are probably a little early to have that conversation.
Okay, all right. Take that point. Thank you so much for joining us today and telling us what is expected from the capital goods space and the outlook going forward as well. That's the word coming in from Goldman Sachs. For now, we'll slip into a short break. When we come back, we'll talk about the commodity space with Manisha Gupta.
Welcome back. 70 points higher on the index currently, still in that very narrow range that it has continued to be in over the last few sessions, almost in 80-point trading range that we have had all through the day, and it continues to remain. So the broader markets have seen some bit of recovery at the start of the session from the lows of the day. Had the mid-cap index recovered almost more than 130 points now from the lows of the day. So keep an eye out on the mid-cap index. But shifting focus to commodities, Manisha is here with us, and she is here to talk about metals, and they are buzzing in today's session, aren't they, Manisha?
Oh, well, yes, they are. It's a third straight day, by the way, Hormuz, in this week that we're looking at metal prices continue to trade firm there are three macro numbers that really seem to be supporting the prices. One is, of course, China building 1.2 trillion yuan, biggest hydroelectric dam. And that would mean a lot of use of cement and glass and all kind of metals. And is the reason you've seen these sectors do quite well in the international markets. Apart from this, the China ministry is pledging to grow in sense of auto and electric equipments, the demand therein and the supply as well. So that has been supportive as well. And then you have the US dollar and the treasury yields continuing to decline, in turn supportive for many of these dollar-denominated commodities. So when you look at the nickel prices, we are trading at a one-month highs on this. Indonesia, remember, has cut nickel mining and it has cut it by 120 million tons to almost 150, and that has been supportive. And then you're looking at copper prices trading not too far away from its all-time highs that we saw in the US markets. Even LME has seen some support coming in. The tariffs that are expected to take cognizance from 1st of August will include refined copper and cathode as well. So this is where you've seen extra price premium coming in as well. So it's not just about nickel and copper. Take a look at aluminum prices, lower supplies, improved European Union demand, and China production bound to have an annual cap around 45 million tons has been supportive for aluminum as well. Markets also are looking at ferrous metals doing quite well. So you have iron ore prices trading at around 5-month highs, steel prices trading at a 3-month highs as well. This is because China's public expenditure is supposed to be higher, and then China is working on reducing overcapacity, also cut excessive competition between steel mills. So it's about individual fundamentals and macros as well that has been supportive for metals.
Thank you very much for that. You guys were talking about how today will be the last of the IT earnings, the big ones at least. So Infosys today, and as you rightly said, Persistent and Coforge, these are the two fastest growing mid-cap companies, and all will be reporting numbers post-market hours. Now let's get to Infosys. Now if you remember that all the four other IT companies that reported numbers, the TCS, Wipro, HCL Tech, TechM, all reported a revenue decline in the current quarter. Negative quarter-on-quarter revenue growth. But Infosys will be the only one in the large cap IT space with a positive growth. 1.5% constant currency revenue growth. In dollar terms, 3.2%. There will be a benefit of the acquisitions that they did last quarter. They had announced so a 2-month benefit coming in from the Missing Link and MRE acquisition. So that, according to some analysts, will contribute about 30 basis points. EBIT margins are seen slightly lower, 20.7 versus 21%, while profits will be up nearly 4.5%. The key is going to be the guidance. The current guidance stands at 0 to 3% top line. Because they've done 2 acquisitions, which will contribute, analysts say the company will raise the lower end of the guidance. 0 to 3 becomes 1 to 3. But unless they touch the upper end, a 3%, it's unlikely to be a positive signal in the market. Margin guidance is likely to remain at 20 to 22%. What else will you watch? The usual, right? Like how is the macro environment? How are the companies behaving? What's the deal pipeline, decision making? Generative AI wage hikes this time has been a topic of conversation because so many of them, companies citing uncertainty, have deferred or pushed forward the wage hike decision. So all that will be tracked. But in terms of numbers, the guidance for FI26 will be very, very crucial. If they can change the upper end of the guidance, that would be read very well by the street.
Okay, all right. So that's what we're expecting from Infosys today. From one tech, let's go across to the other tech now and get in Mitesh Thakkar for a quick technical check on the markets. Mitesh, thank you so much for joining in. There's been some recovery on the mid-caps, Nifty holding on above the 25,100 mark for now. What are the next important trades to watch out for?
See, to be very honest, I think, on the Nifty, I believe that we are still in some kind of a contraction and consolidation, broadly 25,250, 300 to about 24,900. And the way the indicators are shaping up, this range could be in force for some time. So I would avoid trading the index, but be worried in case we get below 24,900 and look for a breakout about 24,300, 340. So for the time being, I think avoid the index. I don't think it's giving you a very strong direction bias.
What about specific stocks, Mitesh?
I have NTPC on the radar. I think there's another stock which, if you look at the last about 8-10 days of price movement, has been doing a range of 350, 340, and now is showing first signs of expansion. So buy about 345, it's at about 343.5 right now. Buy about 345, keep a stop at about 341, and 355, 360 should be the target range for the stock. And a couple of realty names, that's something which is slightly on the negative side. So earlier I had a sell on Lodha Developers. Now, I think Oberoi Realty is a sell with the stop at about 1782 for targets of roughly around 1710.
What about Paytm, Mitesh? It's seen a very significant run up, right, from the Feb 2024 lows that it had. Is reacting to results today from almost 300 levels. The stock has gone up to 1100. Where do you see that now? Has it run its course for now, or are the charts still indicating some more strength?
So I think to me, Paytm, has had a very good rally. In fact, we had 2 or 3 times buy calls also over there. The important thing is that the stock is breaking above the highs which it made in December of 24. That was about 1022, 1030 zones, which is where we had the highest monthly and the weekly closings. So as long as above that, good chance that the stock is looking at targets of around 1200 plus. So if you have hold it on, in case you get a mild decline, pull back to about 1040, 45 zones, that's your entry point with the stop below 1010.
Thank you very much for joining in. Get into a break. On the other side, we'll be joined by the management of Jana Small Finance Bank to discuss their Q1 earnings. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Jana Small Finance Bank, the stock is on our radar now. It is down over 6% after its Q1 earnings. The company's profits have fallen 40%, while gross NPAs have risen too. To understand the quarter gone by and most importantly, the way forward, we are now joined by Ajay Kanwal, who is the MD and CEO at the company. Mr. Kanwal, good morning. Thank you so much for joining in. The general suggestion has been that the worst is over for the industry. That is something that you mentioned in the last quarter conversation as well. We spoke to Mr. Mishra of MFIN recently. He said maybe the worst is behind the sector now. But still, we have seen a spike in gross NPA for Jana Small Finance Bank by 20 basis points. Can you explain what went wrong here and which category particularly led to that spike in gross NPA?
So good morning to you and the viewers. Yes, the 30% of our book as of March 25 is MFI book. 70% is non-MFI, which is largely property-backed, affordable housing, micro-LAP and others. And we have seen the first quarter, the increase of delinquency and NPA in our MFI book. I guess all of us were a bit more optimistic about when it will plateau out. And it has carried on a bit more than we all anticipated. Certainly we did. And that is where it's been an increase of gross NPA to 2.8%. It was roughly 2.7, so it's, or rather 2.6% as we finished March. Nothing that shakes us significantly, but it certainly makes us work harder.
What was the extent of pain, particularly in the MFI segment, 30% of your book? And do you think in Q2 that pain persists, lingers, or are there signs that it's peaked out now?
So the gross NPA for the MFI book is 5.7%.
Okay.
The gross NPA for 70% of our book, which is a secured book, is 1.5%, with a net NPA of 0.8, and in the unsecured book, the net NPA is 1.2. So we are very well provided, and we have taken additional excellent provision of 150 crores in Q1, which is why you see the PAT is at 100, to make sure that we are very well provided as we go into the next few quarters. We do see a small drop in Q2 and a significant drop in Q3. So what we saw, flow of customers both from Jan to March and a bit in April. So these are the 4 months which will then flow into NPA, which is why it will go up into Q2. And then there is no fresh incidents of any change externally. Our collections in May and June are at 98.6, 98.8, 98.6. So I think we are now looking at a very reasonable output after that. So Q3 will be a significant decline. Q2 will be a small decline. And there's nothing else which tells us that this should get worse then.
So what are the numbers? 5.7% in Q1. What could Q2, Q3, Q4 look like if you had to, make an estimate?
Tough to answer that because see, it's a denominator and numerator also.
Yeah.
And one of the things that has not helped the MFI business for us is our total book, which was around 10,000 crores, is down to about 8,680 crores. So the denominator has shrunk. So obviously the gross NPL looks more elevated. How much we grow the denominator will be one question. We would like to grow that very, very carefully. It's a short-term pain for sure, because when your MFI book drops, you do lose revenue. On top of it, you do have increased credit cost. And of course, for collection, you put in extra collectors. So the cost line also doesn't help you. So all three lines have not worked for us in the first quarter. We'll see some relief on the cost side because we are fully capacitized for collections. We should start seeing some positive shoots on the MFI book, on the growth side, and on Q3, then we should see the drop off in the NPAs. Q4, if all goes well, as you know, MFI does reward very well in good times. So if all three lines go right, then I think it should be very positive. But importantly, you see our secured business is doing extremely well, which is where our primary focus has always been. That's 70% of our book. It has moved to 71% in the first quarter. Numbers on gross NPL, like I mentioned, is 1.5%. And we do expect this book to continue growing at a 35% rate for the year. So asset growth will be strong. NPA numbers are good. Yes, we will have to live with the MFI book pain for a quarter, at best two, which is Q3 should get better, but we should really see back to growth in a full form probably in Q4.
Right. Mr. Kanwal, thank you for joining in. Since we were on this subject, your credit costs also went up this quarter, right? What is now the ideal range that you see? Now, you're anticipating some relief to come in from the third quarter. What is the ideal range for credit costs that you envisage for the full year? And the fact that you have 30% of your book as your MFI book, do you see that mix changing since your secured segment is doing so well, as you mentioned? Would you want to increase that exposure and that part of the mix to say around 75% or maybe even higher going forward?
So we have stated upfront a few years back that our secured book should be 80%. So that doesn't change. Secondly, we've said our unsecured book, we would like to put it under the CGTMSE and CGMFU program to prevent any event risk. So as we speak, as of June, 36% of our unsecured book is already under the guarantee program. So two things. We're at 71% secured. We would like to get to 80. We would like to put more and more of our unsecured book into the guarantee programs. 36% achieved. It was 28 in March. It is 36 in June. We'll probably see a 45 to 50 range by September. So two activities. Third, on the credit cost, I think it's very important to understand. See, a regulatory provision that is required is 46 crores for the quarter. On top of that, we have done accelerated provision, which is not required by regulation, of 150 crores. So the only way to think about it is, yes, we would like to create buffers for provision.
Right.
Unless we don't see a very clear environment ahead of us on the MFI piece. So is the credit cost really 150? I don't think so. With the accelerated provision, I'm sure there'll be some better answers coming up in the next 2 quarters. But to ensure that we are having a gross NPA of less than 3 and net NPA less than 1, which has been our stated stance, we have paid an accelerated provision of 150.
Got it. Okay, so Mr. Kanwal, then before we wrap up this conversation, what is the outlook for FI26? You had an ROA guidance of 1.6 to 2%. Currently, it's 1.1%. Are you on track to achieve that? What would the credit cost look like by the end of this fiscal? And what about net interest margins as well? They have fallen 50 basis points quarter on quarter. Can you tell us the FI26 plan? What are the numbers looking like broadly?
So let's start with the last one first. Gross yield of the asset book is 16.5 in March. It is 16.5 in June. So there is no drop off on customer yields. Due to a variety of HDMs and OMOs, some of the high yielding treasury book has been sold. The buyback is of low yielding, which is where the NIM challenge has come. Positive side is, you've seen the repo rate cuts. We have cut our deposit rates by 50 basis points from a 825 to a 775. So we should see cost of funds for the bank coming down in Q2. As we said, we will see some MFI growth. Maybe it's 2%, 3%, depending on how it all pans out. There'll be again a climb back of NIM because that is the highest NIM book. So yes, from a drop of 50 bips, which is largely not led by pricing of customers on the existing book, we will see some recovery back. We would expect a 7.2, 7.3, and which is what we said in the investor call yesterday. So that's on that piece. See, on the two important things, which are very strategic and clear in nature. We had said in our guidance 20% asset growth. We are reiterating that. We had said we will move secured much more than 70 to a 73, 75 range. We are committing to that. Last year, we could deposit book at 29%. This year, certainly we have reiterated 20%. That won't change, and we are saying cost of funds will also drop. So we are getting the two parameters right. A secured business gross NPA, which is the largest book, gross NPA, net NPA remains in very good shape. That doesn't change. I think the only variable which we have to address are the two variables, which one is how fast does the MFI stress come down? And second is, do we grow MFI? And if yes, how much? So just two really, that's a smaller part of a book, but takes majority of our time in this interview and of course for the bank.
It does, because that's something that the shareholders have been worried for as well, right? And that explains the 7% fall in the stock price as well. But thank you so much for joining us today and clarifying on a lot more aspects and talking about the future of the MFI industry as well. With that, we'll slip into a short break. We'll get more on the markets on the other side. Stay tuned.
Welcome back. There are a lot of movers in the broader markets though. ION Exchange is one such mover among the top losers on the small cap index today. 11% lower on that stock at 482 is ION Exchange. It's some of the big volume movers though. Green Panel Industries is one of them. That stock is up 5% among the top volume-led gainers today on the index. So Green Panel Industries is one of them. Bombay Dyeing continues to build on to those gains, now 13% higher on that stock as well. But our research team is here with some of the other movers. Vinny is here to tell us more about Orion Pro Solutions, which is under pressure. Vinny.
Hi, good morning. So yes, we're seeing Orion Pro that is under pressure. This is after their Q1 FI26 numbers. First, taking you through the numbers. On a sequential basis, the revenue's just seen a growth of 3%, profits are up just marginally by 2%, and EBITDA margins have remained largely flattish at 20.3% on a quarter-on-quarter basis. Now, when you're looking at these numbers on a quarter-on-quarter basis, this is one of the slowest growth that we've seen coming in for the company in almost 2 years. And on a year-on-year basis also, the growth is just at 28.7% for Q1 FY26. This is a revenue growth I'm talking about. Last when we spoke to the management, that given a guidance of around 30% CAGR growth for the full year of FY26. So it's below that 30% that what we are watching out for, but we still have the remaining quarters left, though the company has highlighted that they are holding on to their full year growth guidance. It will be interesting to see in terms of specific sector-wise performance that has come in for the company in terms of banking as well as tech. But as of now, the management is saying full year guidance is what they're maintaining, but growth is slower than what we have seen in the past. So that is why you're seeing some bit of a pressure coming in. A miss on the operational front. Client addition has been interesting at 16 client wins during Q1 FY26. So that was a positive, but operationally a weak performance.
Operationally a weak performance. Vinny, thank you for that update. The other one that has been moving around today has been Paytm. And it's been the stock that has been in focus over the last month or so now ahead of its results. The stock fell almost 2% and now has recovered from those lows and is now trading 2% higher. There was an upgrade from Jefferies. On the flip side, there was a downgrade from CLSA. Gaurav is here to tell us about both the bull and the bear on Paytm. Gaurav.
Well, yes, when we talk about Paytm now, we are seeing some kind of mixed reaction from the investors, and the reason being that first is that the results were very strong. Paytm in fact reported profits of around 120 crores in this quarter, which was actually not expected by any of the consensus players. But now there are two cases, bull versus bear. First, let's talk about bull, where Jefferies has upgraded the stock to buy and also increased the target price to 1250. What they're saying is that EBITDA definitely was higher than what the street is expecting. MTU, which is monthly transaction user growth, that was actually encouraging. And on the other hand, what another point that they have put is that when it comes to valuation, They believe that it is trading at a discount to a company, tech company like PB Fintech, and that is the reason why they are being bullish, because they believe that there is a compounding story from here on in terms of Paytm. In fact, Citi also maintained their buy rating and increased the target price to 1215 rupees. On the other hand, on the bear side, we have got CLSA, who downgraded the stock to outperform and gave a target price to 920. Now, this downgrade is specifically because of the outperformance that we have seen for the stock. Let's not forget that in the last 1 month itself, stock has rallied more than 20%. So what they're saying is that definitely the stock performance was actually higher than the street's expectation. But there is another point that they have highlighted. It is that when we talk about the loan distribution, Paytm has actually discontinued their default loss guaranteed loans from one of their largest lending partners. And this is the reason why they believe that the upfront cost has come down because of the DLG loans are not there. But on the other hand, in terms of revenue, the deferred revenues are still reflecting, and that is the reason why they also believe that the EBITDA can actually come down. In fact, they have also cut down their EBITDA guidance and EBITDA expectations almost by 4 to 8% for the next 2 years. So definitely that is another case that they have put in. We also have Macquarie, who has maintained their target price of 760 rupees. So as a result, we are seeing some volatility in the stock. So definitely in terms of numbers, they were good. But in terms of brokerages, we are seeing two groups which are forming right now.
Thank you very much for that. Let's talk about Colgate. The numbers seem to suggest that fewer Indians have brushed in Q1. There is a volume decline. Mangalam now joins in. Mangalam.
Well, I'm not sure whether fewer Indians brushed in the first quarter or not, but what I can tell you is that fewer Indians perhaps brushed using some of the popular products of Colgate, because the company attributes a higher base, higher competitive intensity and weak consumer sentiment in the popular version of their products. But premium products have been doing well. They expect gradual improvement in the second half of this year. It was not as much the numbers which were expected to be weak, and they were weaker than estimates. It was a management commentary that spooked the street. And thereafter, there were a lot of brokers as well, which have downgraded their estimates and outlook on the stock along with lower prices. So you have, for instance, HSBC, which has a hold call. They've cut the target price to 2,600 rupees. They're saying there is improvement which is anticipated, but the structural potential for growth is low. Nomura has reduced their call, and their target price too is at around 2,350. They expected the volumes to have declined by about 3 to 4% in the first quarter, not just 2%. And Goldman Sachs has lowered their estimates by about 3 to 4%. They have among the lower target prices on the street. Citi too has lowered their target price from about 2,300 rupees to 2,175. They are saying that challenges are likely to persist in the second quarter as well. Nuvama, one of the sole buyers on the stock, they believe that recovery could lead the stock higher. They have a target price of around 31.35. But be that as it may, for Colgate, the bigger challenge, apart from category growth, is the lack of growth coming in from ancillaries. The management has been speaking about 2x growth coming in for their Palmolive vertical, but we're not sure whether that's become substantial enough to drive overall growth for the company right now or not. Weak consumer sentiment one side, but on the other side, we have competitive intensity and lack of growth in the category, which is hurting the stock.
Okay, so it's a category problem, not a toothpaste particular problem. It would be scary if people are not brushing enough in the country.
But we were talking to Rahul Arora of Nirmal Bang on Editors Roundtable, and he said that, the penetration of toothpaste is 90% plus. The only problem is we brush once.
Yeah,
a large part of the population is still brushing once a day, and they haven't moved. Sorry, Mangala?
No, I was saying that I was looking at data coming in from Colgate itself, and they've said that there are only 20% rural population that brushes once a day. 80% doesn't even do that. And in the urban population as well, more than half, or closer to 60%, if I remember that number correctly, brush just once a day. And the comparable numbers for other countries with similar, GDP per capita is close to 4 times, 5 times a day, etc. So, all you have to do is brush more than once. The product is there in everyone's house, but not necessarily being used.
Maybe dentist ka sujaya one number one brand, but I don't think the street is very convinced.
But we forget there are other brands as well. It's not Colgate. That's exactly the point. We need to talk about that as well. It's just not Colgate which has a toothpaste brand. Thank you so much, Mangalam, for joining us with all those insights. We'll do one thing. We'll slip into a short break. When we come back, we'll get to you more on the markets on the other side. Stay tuned.
Welcome back. Tata Consumer is amongst the big losers today, down over 1%, and the stock has breached the 100-day moving average on the way down. 1% down, not down by a whole lot, but it's slightly on the weaker side. Mangalam is back with us to set the expectations for Tata Consumer.
Well, we don't know about toothpaste, but more salt was definitely consumed this time in the first quarter. Why do I say that? Because Tata Consumer, the stock has done well this year so far, up around 18%. But importantly, the street is expecting double-digit revenue growth to come by. 11.5% on the top line, close to 4,850 crores what the street is working with on a consolidated basis. EBITDA declines by about 7%, but that's largely on account of some of the key input inflation, be it tea, be it coffee, or at the same time, we are seeing some sort of inflation coming by in the salt portfolio, where the company has gone ahead and taken price hikes. Net profit comes in at 330 crores versus 290 crores, so that's a jump of almost 14% year-on-year. India foods business revenue growth seen likely between 13 to 15%, led by price hikes in the salt portfolio and premiumization out there. Beverages should grow 8 to 10%, and that would largely be on account of price hikes taken in the tea portfolio. Capital Foods and Organic India, the acquisitions that the company had made, could do about 350 crores in a quarterly, in this quarter's revenue, but the company expects this number to jump to almost 500 crores per quarter by the second half of this year. Narishco, that was the growth driver of the company, may report a muted quarter this time around because of unseasonal rains and the beverage portfolio being impacted by overall summer. But by and large, the management expects Soulful, Narishco and Sampann, the growth drivers of the company, to grow upwards of 30% with double-digit revenue growth this year with increasing margins. Whether that happens in the first quarter or not, well, the street will keep an eye out on that.
I can say that with certainty that the salt was found in our food items more than the toothpaste for sure. Mangalam, thank you for that. The other major Nifty name reporting results today is Dr. Reddy's, and Ekta is here with what the street is expecting from that stock. Ekta.
Thanks for that. Well, yes, for Dr. Reddy's, this quarter we are expecting a revenue growth of around 13-odd%. The margins should probably come in at around 25-odd% this quarter, and a profit growth of around 6-odd%. Now, the revenue growth is expected to be led by the integration of a recent acquisition, the Nicotinell acquisition. North America sales are expected to be under pressure because of price pressure in key drugs such as Revlimid generic, and estimates are quite wide for North America. It's all the way to a decline to a marginal growth. So do watch out for that. For Revlimid generic, sales estimates are wide, so anywhere between $140 million to $180 million versus $150 million year on year. Expect India to grow around 8 to 10%, aided by the licensing of the Sanofi vaccine portfolio and a joint venture with Nestle. Margin range again is wide, anywhere between 23 to 28%. A semaglutide opportunity, commentary will be watched out for that. Estimates are they could generate around $280 million in terms of sales in FI27, driven by Canada. More details on the Delhi High Court restraining Dr. Reddy's and OneSource from selling semaglutide in the domestic market, and the update on a couple of biosimilars that they have in their portfolio, the launch on that front.
All right, we'll be watching out for that one. Important earnings expected today, but time for a short break now. We'll get more on the markets and the stock-specific action that we've been tracking on the other side.
Welcome back. Some more result reactions coming in. Cyient DLM is one of them that reported numbers after market hours last evening, and Upasna is here to take us through the results for Cyient DLM. So Upasna.
While the companies reported a mixed set of numbers, the revenue and PAT are below the street estimates, while the EBITDA margin is above street estimates of 8.5%. Now, coming to the numbers first, the revenue saw an uptick of just about 8% on a YoY basis. EBITDA saw an uptick of nearly about 25%, and EBITDA margins stood at 9% with an uptick of nearly about 120 basis points. This is on the back of the change in the product mix of the company. PAT saw a downtick of 30% on a YoY basis. This is mainly because of the downtick in the other income of the company, which has impacted the PAT. Now, looking at the other key highlights of the results, the revenue growth, mind you, for this quarter has slowed down to single-digit 8% after the record double-digit growth seen in the past 4 quarters of the company. The company said that the revenue growth is impacted mainly because of the completion of the large order in FY25 itself. Now, defense segment, which was in focus for the past few quarters, this has seen a degrowth of nearly about 82% due to large order completion in FY25 as highlighted earlier. And next up is aerospace segment of the company, which has seen a healthy growth of nearly about 63% on a Y-on-Y basis. Now, EBITDA margin has seen an improvement of 120 basis points due to better revenue mix. And the other key positive is the order backlog. The order backlog increases resulting from a record order intake of nearly about 515 crore during the quarter. And this is the highest quarterly order intake seen in the past 10 quarters is what is highlighted by the company. So overall, mixed set of numbers coming in from Sign DLM.
Okay, all right, mixed set of numbers. There's been a recovery in the stock, now down 2%. By the way, from the broader markets, if you look at some of these names, Lodha Developers, Oberoi Realty, of course, there's this block deal that has come by. So both these stocks are in focus. Lodha is down 6.5%. We have Oberoi Realty, which is down 3.5%. Z Entertainment reported numbers during the dying hours of trade yesterday. It was a weak set. The stock was down around 5% yesterday, continues its down move today. So those are some broader market movers. But for now, we'll take your leave on trading hours. Stay tuned. Halftime report will take all the action ahead.